This tutorial focuses on entering data into the SSEG impact model. In video 1, we went through the various sheets in the SSEG impact model, and we suggest that you view that video before watching this one. Having gone through the various sheets, we will now focus on the standard model inputs, advanced model inputs, and printable report sheets. The standard model inputs sheet contains all the variables in the model that need to be entered in order to reflect the specific characteristics of the relevant municipality. 4 customer classes are defined in the model and are categorized according to the size of their connection: residential, small business, medium business, and large business or industrial customers. Data needs to be provided for each customer category, and the model provides results per customer category in the financial impact model results and the business case results sheets, as well as the printable report. All inputs should be entered in the yellow highlighted cells. I will now take you through the model and enter City of Tshwane data for residential customers by way of an example. Firstly, the name of the municipality should be entered, and the closest location to this municipality should be selected in the drop-down box in order for the model to use the most appropriate solar generation data for that municipality. Select cell I-15. A drop-down arrow with a list of locations will appear. There are 14 locations for which the model contains solar irradiation data to choose from. Users should pick the nearest location to the municipality, which in this case is Pretoria. Now we look at the municipal tariff section. These tariffs should reflect the tariff type and magnitude of the tariff that the user wishes to test. Customers will shift from only this tariff type to SSEG tariffs. For municipalities who already have SSEG tariffs in place, these tariffs pertain to customers who are not on the SSEG tariff. These are regular tariffs. For each customer class, select the type of tariff in place. A drop-down arrow will appear. Select the drop-down arrow and pick the appropriate tariff: time of use tariffs, inclining block tariffs, or flat tariffs. A time of use tariff is a tariff with energy charges that change during time of use periods and seasons. Time of use periods are generally classified as peak, standard, and off-peak, which are different in summer and winter. Inclining block tariffs divide the electricity price into several blocks. The first block of electricity is at the lowest price, and as the customer uses more electricity during the month, that electricity falls into subsequently more expensive blocks. A flat tariff is a tariff with energy charges that are constant over time of use periods. Once the type of tariff has been selected for each customer category, the model will highlight in yellow the cells where the tariffs applicable to each customer type need to be inserted. Enter the appropriate tariffs in the yellow highlighted cells. Because we've chosen inclining block tariffs for the City of Tshwane, you can see that the relevant cells are now highlighted in yellow. For inclining block tariffs, rows 45 to 76, enter the fixed monthly charge in Rand per month in row 45 and the monthly demand charge in Rand per kVA in row 46, and then enter the block tariffs. A block in the model is a consumption range over which a certain tariff is applied. Block 1 in the model refers to 0 to 100 kilowatt hours for City of Tshwane, over which a tariff of 130.32 cents applies. For each block, enter the lower and upper limits of the block and the tariff applied to consumption between the lower and upper limits. Note that the next block should start 1 kilowatt hour after the last block, even if this isn't reflected in the tariffs. Example: the first block in this case is 0 to 100 kilowatt hours. The second block is 101 to 400 kilowatt hours and not 100 to 400 kilowatt hours. If there is no upper limit on a block, leave the upper limit cell blank. For City of Tshwane, this would apply to Block 4. The lower limit of 651 kilowatt hours is entered in cell N64. There is no upper limit, so cell N65 is left blank, and the applied tariff of 179 cents is entered in cell N66. The bulk power purchase tariffs paid by the municipality to Eskom are entered in the bulk power purchase tariff section, rows 94 to 100. Bulk power purchase tariffs are time of use tariffs and have separate tariffs for summer and winter. Both summer and winter consist of separate peak, standard, and off-peak tariffs expressed in cents per kilowatt hours. The solar PV installation section should only be changed if there is better data known to the municipality. Otherwise, the data that has been hard-coded into the model will suffice. For each customer class, enter an average solar PV system size measured in kilowatt peaks in row 106. The cost of the system measured in rands per kilowatt peaks in row 108, and any government incentive subsidy in place for installing solar PV systems measured in rands, if applicable, in row 111. Cell I-106 contains the average size of the solar PV installation in kilowatt peaks for each customer type. The average for residential customers is 2 kilowatt peaks, for small businesses 5 kilowatt peaks, for medium businesses 15 kilowatt peaks, and for large businesses 200 kilowatt peaks. Note that the cost per kilowatt peak in row 108 has been coded to change depending on the size of the solar PV installation, but a user should enter the most up-to-date data if available. The electricity sales section requires information on electricity sales for those customers that are on the tariff that has been entered by the municipality in the municipal tariff section. Users need to enter the number of customers on the relevant tariff in row 118 and then either electricity consumption per annum for a representative customer in row 121 or total volume of electricity supplied per annum to that group of customers in row 123. The technical losses section requires the percentage of electricity purchases from Eskom that are lost due to power dissipation in the electricity system. The percentage must be entered in percentage form. Now we look at the proposed SSEG tariff section. The SSEG tariffs that the municipality is proposing to put in place for customers who choose to install solar PV should be entered in the proposed SSEG tariff section. The model will test these tariffs and determine how they affect municipal finances and how they affect the business case for customers installing solar PV systems. There are 5 drop-down boxes, rows 135 to 143, which allow the user to customize the SSEG tariff for each customer group. These options are as follows. Firstly, are SSEG tariffs available? If yes is chosen, then enter all the other information that is required in this section. If no is chosen, then no more data should be entered. The model will make use of the municipal tariffs as SSEG tariffs and no exports onto the grid will be allowed. Secondly, do you want to test a time of use or flat SSEG tariff? The model accommodates both time of use and flat tariffs and will highlight in yellow the relevant sections where the tariffs should be entered. Thirdly, should credit balances be cleared every month or rolled forward and cleared at the end of the year? Users should choose either monthly clearing or annual clearing from the drop-down box. This choice affects how the SSEG customer's bill is calculated. If credit balances are cleared every month, then the export balance is set to 0 at the end of every month, and an excess of exports over imports in one month can't be used to offset imports in the next month. However, if balances can be rolled forward, then this can occur. Next, can the municipality pay customers for credit balances, or are these balances set equal to 0? The user has the option of choosing whether customers can be compensated for producing more electricity than they consume or not. Lastly, does the export tariff change over time, or is it fixed? If the export tariff changes over time, it will increase or decrease in line with the tariff escalation rate. If it doesn't change, then it is fixed at the amount specified by the user. This affects the business case only. If time of use tariffs have been selected, these tariffs should be entered in rows 150 to 172. If flat tariffs have been selected, these should be entered in rows 178 to 192. If no SSEG tariffs are available, then all sections should be left blank. The appropriate SSEG tariff data should be entered in the yellow highlighted cells. Import tariffs refer to what the customer pays the municipality for electricity consumed from the grid. Export tariffs refer to the compensation the customer receives for exporting electricity onto the grid. For time of use SSEG tariffs, enter the import and export tariffs separately in the relevant rows, rows 151 to 161, and rows 166 to 172, even if these tariffs are the same, and for both the import and export tariffs, enter separate summer and winter tariffs. Both summer and winter tariffs for both import and export tariffs consist of a fixed monthly charge in rands per month, a monthly demand charge expressed in rand per kVA, and separate peak, standard, and off-peak tariffs, which are expressed in cents per kilowatt hours. For flat tariffs, enter the import and export tariffs separately in the relevant rows, rows 179 to 185 and 190 to 192, even if these are the same, and for both the import and export tariffs, input separate summer and winter tariffs. The summer and winter tariffs for the export tariffs consist only of average variable charges per month in cents per kilowatt hours. Both summer and winter tariffs for import tariffs consist of an average fixed charge in rands per month, a monthly demand charge in rand per kVA, and average variable charges per month in cents per kilowatt hours. The next three sections focus on the customer load profiles, tariff escalation, and business case assumptions. The user is given the option of entering their own customer load profiles or using generic customer load profiles, entering their own tariff escalation percentages or making use of those that have been hard-coded in the model, and entering their own business case assumptions or making use of those that have been hard-coded by the model. If the user chooses to customize load profiles, enter their own tariff escalation percentages or business case assumptions, i.e. chooses yes for any of the three options, the user's customized data should be entered in the advanced model inputs sheet. Now we look at the advanced model inputs sheet. As explained, if a user chooses to enter customized load profiles, tariff escalation percentages, or business case assumptions, these should be entered in the advanced model inputs sheet. Customized load profiles should be entered in item 1 of the advanced model inputs sheet. Users should enter the percentage of total electricity used by the half hour for a typical day in winter and summer during the week and weekend. Cells F24 to I71 for residential customers, F80 to I127 for small and medium business customers, and F136 to I183 for large business customers. As a check, the sum of the half-hourly load profiles for a typical winter or summer day during the week or weekend should equal 100%. Tariff escalation percentages should be entered in item 2 of the advanced model inputs sheet, rows 190 to 193. There are 4 different tariff components that can be customized. These are the import rate, the export rate, the demand charge, and the fixed monthly charge. A number of business case assumptions can also be adjusted. These are the tax rate, row 201, the risk-free rate, row 202, financing options, i.e. the proportion of the cost of the solar PV system financed via cash, short-term loans and long-term loans, rows 204 to 206, the interest rate for the various financing options, rows 208 to 210, and the term in years of the various financing options, rows 212 to 214. All business case inputs, except for the term of the various financing options, which should be in years, must be entered in the cells as a percentage.
Next, we will look at the printable report. This printable report shows the results for all customer types. Table 1 shows the tariff types and levels as entered by the user. So, for example, for residential customers, the user has entered a flat tariff. Credit balances are cleared annually, that is, they can be rolled over from month to month. Payments can be made to customers, and the export tariff is constant over 20 years. In this example, there is a fixed charge of 150 Rand per month. The import tariff is 150 cents per kilowatt hour, and the export tariff is 83 cents per kilowatt hour. These charges are the same in both summer and winter. Now let's look at the large business tariffs that the user has entered. These are time of use tariffs which are cleared monthly. Payments can be made to customers, and the export tariff changes over time. Lines 18 to 26 show the various components of the time of use tariff. In both summer and winter, there is a fixed monthly charge of 1,886 Rand and a monthly demand charge of 157 Rand per kVA. In summer, the time of use tariffs are 120 cents per kilowatt hour for peak, 74 cents for standard, and 53 cents for off-peak. The export tariff is 83 cents for all time of use periods. In winter, the import tariffs are 314 cents for peak, 115 cents for standard, and 61 cents for off-peak. As in summer, the export tariff is 83 cents for all time of use periods. Table 2 then shows the total revenue impact for each customer type for 4 different uptake percentages. In other words, results are shown under 4 different assumptions regarding what proportion of customers in each customer category have installed rooftop PV. The options are 1%, 5%, 10%, and 20%. Total revenue impact is calculated as follows. It is equal to the reduction in municipal revenue plus the value of solar divided by the municipal revenue prior to the introduction of solar PV SSEG tariffs. Recall that the value of solar consists of the reduced bulk power purchases, the reduced technical losses, and the increased margin from on-selling electricity purchased from SSEG customers. If we look at the results for residential customers, we see that if 1% of customers install rooftop PV, the municipality's revenue increases by 0.02%. If 5% install solar PV, revenue increases by 0.09%. If 10% install, revenue increases by 0.18%, and if 20% install, revenue increases by 0.36%. If we look at the results for small business customers, we see that revenue falls by 0.05% if 1% of customers decide to install rooftop PV. As greater proportions install, the decrease in revenue increases. Also, take note of the total column, where the results are consolidated. In this case, if 10% of all customers in the given tariff categories decide to install rooftop PV, then, given the SSEG tariffs as entered by the user, total municipal revenue will decline by 0.07%. Chart 1 is a graphical representation of the data in Table 1. The various uptake proportions are plotted along the horizontal axis, and the vertical axis shows the change in municipal revenue. Table 3 shows the reduction in revenue and the value of solar and the total effect in millions of rands. The total effect is the sum of the reduction in revenue and the value of solar. So, by way of an example, for medium businesses, if 1% of them decide to install rooftop PV, the reduction in revenue will be minus 1.2 million rand, the value of solar will be 0.8 million rand, and the overall impact on the municipality will be a loss of around 300,000 rand. Table 4 then shows the business case for the solar PV customer that is deciding whether or not to install rooftop PV under the given set of tariffs. The model applies conditional formatting to the business case results to assist the user in interpreting these results. For the payback period, if this is greater than 10 years, it is deemed unfavorable. Between 5 and 10 years, it is average, and if it is less than 5 years, then it is classified as very good. For the internal rate of return, an IRR less than 10% is deemed unfavorable. Between 10 and 20%, it is average, and greater than 20%, it is classified as very good. For the residential customers, we see that the net present value is negative. The payback period for the rooftop PV investment is 23 years, and the internal rate of return is 1%. For residential customers, the results indicate that the business case is unfavorable, which means that investing in rooftop PV is unlikely to be viewed as financially attractive for customers under the given set of SSEG tariffs. From the results, it is easy to see that the business case is viewed as average for the small, medium, and large customers. The business case results also show the levelized cost of electricity, or LCOE, and the monthly bill for one SSEG customer. The levelized cost of electricity is the average total cost of installing and operating the rooftop PV system over its lifetime, divided by the total energy generated over that lifetime. Table 5 provides additional metrics of interest to the user. These are the average electricity consumption per annum, the average solar self-consumption rate per annum, and the peak demand per season. Chart 2 shows the energy balances for each user group. These charts show how much electricity is consumed on-site versus how much is exported to the grid. For residential users, just over 2,000 kilowatt hours per annum is self-consumed, and about 1,500 kilowatt hours per annum is exported to the grid. For small business, almost all the electricity is consumed on-site. However, if you look closely, you will see that a very small amount is exported to the grid. For medium and large business, all electricity produced is consumed. This brings us to the end of video 2. Thank you for watching.